The financial industry exists on a compelling premise. Pay us, and our experts will help you build wealth. But the data shows that most investors consistently underperform the stock market itself. To understand why, consider a hypothetical family named the Gottrocks. This family owns 100% of every American business. Because they own everything, they automatically collect every dividend and all the earnings growth those corporations generate. Eventually, the family decides they can do better. They hire helpers, brokers, active managers, and planners to trade pieces of these businesses among themselves, hoping to outsmart each other. The underlying companies generate the exact same profit as before, but now the family must pay fees and commissions to the helpers. Their net wealth drops. Any friction or intermediary in the financial system creates a mathematical certainty. You will receive less than the market's total return. It is easy to get distracted by the jagged daily fluctuations of stock prices, but underneath that noise is the steady growth of actual corporate earnings and dividends. This chart tracks a dollar invested from 1900 to 2016. The dotted line traces the market return, averaging 9.5% per year. 9.0% came entirely from business fundamentals. Only 0.5% came from speculation or changing prices. Long-term wealth is driven by owning productive businesses, not by guessing short-term price movements. When you hire active managers, you pay all-in investment costs. A 2% annual fee might seem small in the short term, but its hidden effect builds massively over decades. This chart projects that 2% fee over a 50-year investing lifetime, beginning with 100% of your potential wealth. By year 50, that lag consumes 61% of your accumulation. You are left with just 39% of the market's total return. The outcome is a severe imbalance. The investor provides the capital and assumes the risk, while the industry takes the majority of the reward. Beyond fees, there is a psychological tax. The average mutual fund investor earns significantly less than the returns reported by the funds themselves. This chart compares profits on a $10,000 investment over 25 years. While the average fund earned a profit of $55,000, the average investor took home just $36,000. This gap exists because investors tend to pour money into funds after they have already peaked and pull it out during temporary drops. The financial industry exploits our natural instinct to chase hot trends, turning reactive behavior into an invisible tax on your savings. The industry's core pitch is that you can pick winning managers based on their past performance. If we track the funds that finished in the top tier of performance over 5 years and follow them into the next 5, the pattern breaks down. Only 13% remained at the top, 27% plummeted, and 10% disappeared entirely. This is reversion to the mean. Reversion to the mean is the statistical tendency for outlier performance to return toward the average over time. Selecting a fund based on its recent hot streak often means you are buying into a manager whose luck is about to run out. The antidote to high fees, impulsive behavior, and mean reversion is the traditional index fund. Instead of paying experts to guess which stocks will win, an index fund simply buys the entire market and holds it forever. This approach drops trading costs to near zero, eliminates management fees, and drastically reduces taxes on capital gains. This chart shows the result. Because they avoid the drag of fees and trading, the index fund investor captures $73,000 in profit, nearly every dollar the market provided. By refusing to try and beat the average, you finish ahead of the majority of participants who tried and failed. You manage market volatility through asset allocation, balancing stocks for growth with stable bonds for protection. Costs are so significant that a conservative, low-fee portfolio can earn more than an aggressive, high-risk portfolio that carries a fee anchor. Wealth generation requires ignoring the frenetic activity and false promises of Wall Street. The winning strategy is the opposite of human instinct. Don't do something, just stand there.